January 23rd, 2025. President Trump walks into the Oval Office and signs an executive order that sends shockwaves through the financial world. He's banning central bank digital currencies in America. Crypto Twitter absolutely explodes in celebration. Victory tweets flood your timeline. Headlines scream about how Trump just saved us from digital tyranny. The narrative is simple and beautiful. Americans won, the government surveillance money is dead. Freedom prevailed. But here's what almost nobody actually did that day. They didn't read the executive order itself. You know what happens when you actually pull up Executive Order 14,178 and read past the headlines? You find something fascinating buried in the text. Right there in black and white, the order explicitly calls for promoting what it describes as dollar-backed digital assets as a strategic priority for U.S. financial leadership. Those are the actual words from the White House document. Think about what that means for a second. This wasn't just a ban on government digital currency. This was a substitution. The administration didn't kill digital dollars. They just changed who controls them. They replaced a government CBDC that everyone could see coming with corporate CBDCs that have much better marketing departments. And you want to know the really clever part? Most people celebrating that day had no idea they'd just traded one form of programmable money for another version that comes with a corporate logo and a terms of service agreement. Now, let's jump forward 6 months to July 2025. Trump signs another piece of legislation that barely makes the news cycle because everyone's still celebrating the CBDC ban. It's called the Genius Act, and this is where the picture becomes crystal clear about what's actually happening to our money. The Genius Act creates the federal framework for stablecoins. You know, those digital tokens pegged to the dollar that crypto enthusiasts love because they think they're getting the benefits of blockchain without the volatility of Bitcoin. According to the law, every stablecoin issuer must comply with the Bank Secrecy Act, implement full anti-money laundering verification, check every transaction against sanctions lists, and submit to Treasury Department Enforcement Authority. Read that again slowly. Every transaction is now legally required to be monitored. The thing people feared about CBDCs, the surveillance, the tracking, the government knowing every dollar you spend, all of that just became mandatory for stablecoins under federal law. But wait, you might be thinking stablecoins are private companies, they're decentralized crypto. They wouldn't actually implement government surveillance into their code. They're about freedom and innovation, right? Let me show you something that should fundamentally change how you think about this entire situation. USDC is the second largest stablecoin in the world, with about $60 billion in circulation. It's issued by a company called Circle, and it's marketed as this stable, trustworthy digital dollar that works on blockchain technology. Sounds great for financial freedom, doesn't it? Here's the reality that exists right now today, not in some dystopian future. USDC has already frozen over 100 wallets at government request. Not might freeze in the future. Has frozen, past tense. Already happened. You can actually go look at the smart contract code yourself if you know where to find it. There's a literal function in the programming called the blacklist. Any wallet address can be added to this list. And the moment that happens, every single USDC token in that wallet becomes completely frozen. Can't send it, can't trade it, can't access it. The money just stops working. This is programmable money with a built-in kill switch. The exact thing that made people terrified of central bank digital currencies. The surveillance, the control, the ability to freeze your money with the click of a button. All of it exists right now in the stablecoin that millions of people use every single day thinking they're participating in decentralized finance. Pop quiz. What's the functional difference between a government agency freezing your CBDC wallet and a private company freezing your stablecoin wallet at government request? Take your time. I'll wait. The answer is, there isn't one. The outcome is identical. Your money stops working. You have no access. You can't pay your bills. The only difference is the logo on the website you're staring at when you realize you've been locked out of your own funds. But here's where this gets even more interesting. Remember how the executive order talked about promoting dollar-backed digital assets as a priority? Let's talk about what that actually means in practice and why the timing of all this matters so much. When you dig into the requirements that the Genius Act places on stablecoin issuers, you find something remarkable. These companies have to back their digital tokens one-to-one with what the law calls high-quality liquid assets. And what's the primary asset that qualifies? U.S. Treasury bills. Government debt. Think about the math here for a second. Stablecoins currently hold about $260 billion in Treasury securities. That's not a small amount of money. Industry projections suggest this could reach $2 trillion by 2028 as stablecoin adoption accelerates. What we're looking at is a system where private companies issue digital dollars, and by law, they must use that money to buy government debt. The stablecoin market isn't just a convenient payment system. It's a captive buyer for treasuries. At a time when our country desperately needs people willing to finance our growing deficits, the government gets to fund itself while technically keeping their hands clean because it's private companies doing the buying. And Americans get to feel like they're using innovative financial technology while every transaction flows through government-compliant surveillance infrastructure. You're probably starting to see why they were so eager to ban CBDCs. Why compete with the private sector when you can just regulate private companies to build exactly the same system for you? Let them take the liability, handle the customer service complaints, deal with the technical infrastructure. The government just sets the rules and maintains enforcement authority. And those rules, as we're about to see, create something that makes traditional banking look like a bastion of privacy and financial freedom. But before we go there, I need you to understand one more piece of this puzzle that most people completely missed. Circle, the company that issues USDC, is actively pursuing a federal banking license. So is Ripple, another major player in the stablecoin space. When these companies become actual banks under federal regulation, something remarkable happens to our financial system. They gain direct access to Federal Reserve payment rails. They can offer FDIC-insured accounts just like traditional banks. But unlike traditional banks with their legacy systems and slow settlement times, stablecoins clear instantly on blockchain infrastructure. What you end up with is a new banking system that looks innovative and modern and blockchain-based, but operates under the exact same government control as the old system. Actually, it operates under more control, because unlike traditional banks where you can still withdraw cash and conduct private transactions, stablecoins are digital only by definition. Every transaction leaves a permanent, traceable record. This is the future of American banking that's being built right now in 2025, not announced with dramatic press conferences or lengthy congressional debates, just quietly assembled through executive orders, industry-friendly legislation, and private companies doing exactly what the government wants them to do, because the regulatory framework makes it the only viable business model. And here's what should really grab your attention. We're talking about replacing a monetary system where you can still go to an ATM, withdraw cash, hand someone a $20 bill, and have that transaction remain completely private. No record, no surveillance, no third-party approval required. The system being built to replace it requires identity verification for every participant, real-time checking against government sanctions lists, and the technical ability to freeze any wallet at any moment. And it's not being forced on anyone. It's being marketed as innovation. You know what the really genius part of this whole operation is? They didn't have to make cash illegal. They just had to make stablecoins more convenient. Instant settlement, global reach, interest-bearing accounts, access to the newest financial applications and services. Why would anyone use obsolete paper money when digital dollars work so much better? The adoption becomes voluntary. People choose the digital system because it offers advantages the old system can't match. And by the time enough people have switched over that, cash becomes impractical for everyday transactions. Well, then opting out isn't really an option anymore, is it? This exact playbook has been run before in American history. April 5th, 1933. President Franklin Roosevelt signs Executive Order 6102, making private gold ownership illegal. Every American had to turn in their gold and accept paper dollars in exchange. The government needed to devalue the currency to fight deflation, but they couldn't do that. While citizens could opt out by holding gold, so they made opting out illegal. The 2025 version is more sophisticated. You don't need to ban cash or make gold illegal when you can simply make the alternative so attractive that mass adoption happens naturally. And once everyone's wealth exists as digital tokens on government-supervised payment rails, Well, then you have the control you need without the political backlash of forcing anything on anyone. This is what was actually signed into law on January 23rd, 2025. Not a victory for financial freedom, a carefully constructed replacement of one surveillance system with another version that comes with better branding and doesn't trigger people's instinct to resist government overreach. The CBDC ban wasn't about protecting Americans from digital tyranny. It was about making sure that when digital dollars become the default form of money in this country, they're issued by private companies that follow government rules rather than by the government directly. The outcome is identical. The optics are just better. Now let me show you exactly how deep this goes, because what we're looking at isn't just some theoretical concern about future surveillance. This is a fully operational system that's being built right now with very specific architecture designed to accomplish very specific goals. Let's start with the money itself and where it actually comes from. Remember how I mentioned that the Genius Act requires stablecoin issuers to back their tokens with high-quality liquid assets? Let's dig into what that requirement actually creates in our financial system. When you buy a USDC token, you hand-circle a dollar, and they're supposed to hold real assets worth that dollar as backing, but they can't just stuff your cash in a vault somewhere. Federal law now mandates that this backing must be held in specific forms, and the primary qualifying asset is U.S. Treasury securities. So here's what happens in practice. Millions of people buy stablecoins thinking they're participating in cryptocurrency and blockchain innovation. Circle takes those dollars and immediately uses them to purchase treasury bills. Your digital currency becomes government debt financing. The current numbers tell a fascinating story. Stablecoin issuers collectively hold about $260 billion in treasuries right now. That makes them one of the largest buyers of U.S. government debt in the entire world. They hold more treasuries than many foreign countries. And the projections for where this goes are even more revealing. Industry analysts expect stablecoin treasury holdings to reach $2 trillion by 2028. That's assuming moderate growth in adoption. If there's a banking crisis or currency crisis that drives people into stablecoins as a safe haven, these numbers could accelerate dramatically. Think about the incentives this creates for our government. We're running massive budget deficits that need to be financed. We need buyers for all the debt we're issuing. And here comes this innovative new financial technology that, by regulatory design, must use customer deposits to buy treasuries. It's a dream scenario for government financing. The government doesn't have to directly print money or obviously monetize debt through the Federal Reserve. Private companies do it for them, and it gets marketed as financial innovation rather than monetary policy. Americans think they're using cutting-edge technology while unknowingly financing deficit spending. But here's where it gets really interesting from a surveillance and control perspective. Let's talk about what actually happens when you try to use these stablecoins for transactions. Every single stablecoin transaction requires multiple layers of verification before it can go through. First, customer identification through KYC processes. That's Know Your Customer in banking terminology. You have to prove who you are, provide government identification, link the wallet to your real identity. Second, every transaction gets checked against OFAC sanctions lists in real time. That's the Office of Foreign Assets Control, the Treasury Department division that maintains lists of people, companies, and countries that Americans aren't allowed to do business with. Your transaction doesn't process until the system confirms you're not sending money to anyone on those lists. Third, all of this transaction data gets reported to FinCEN, the Financial Crimes Enforcement Network. Every meaningful transaction flows through federal databases where it can be searched, analyzed, and used for investigations. Now, let's compare this to the monetary system we still have access to today, at least for now. You go to an ATM, withdraw $100 in cash, hand it to someone for whatever reason. Maybe you're buying something, maybe you're helping out a friend, maybe it's none of anyone else's business what you're doing with your own money. Nobody tracks that transaction. There's no database recording that you withdrew cash. No verification system checking whether the person you gave it to is on a government list. No reporting requirement to federal agencies. The $20 bill in your wallet doesn't know who you are and doesn't care what you buy with it. Or let's compare stablecoins to actual cryptocurrency like Bitcoin. When you hold Bitcoin in your own wallet, not on an exchange, but in genuine self-custody with your private keys. Nobody can freeze those funds. There's no company that can lock you out. No terms of service that can change. No third party with technical control over your money. The Bitcoin network doesn't care about your identity. It doesn't check sanctions lists. It processes transactions based purely on cryptographic proof that you own the private keys. That's actual financial sovereignty, whatever you think about Bitcoin's other characteristics. Stablecoins are the exact opposite of both these systems. Every transaction requires permission from a corporate intermediary who must follow government rules. Every dollar is tracked from the moment it enters the system. Every wallet can be frozen if someone with the right authority decides you shouldn't have access to your money. This is cryptocurrency and branding only. In function, it's more restrictive than traditional banking because, at least with a bank account, you can still withdraw cash and exit the surveillance system. With stablecoins, there is no exit. It's digital only, which means it's trackable only, which means it's controllable only. And the companies building this system aren't hiding these features. They're advertising them as benefits. Circle promotes USDC's regulatory compliance as a selling point. They talk about how their blockchain works with government agencies to prevent financial crime. They position surveillance as safety. You know what's brilliant about this framing? Most people hear prevents financial crime and think that sounds responsible. Nobody wants to be associated with money laundering or terrorism financing. So the surveillance infrastructure gets built with public support because it's packaged as protecting everyone from the bad guys. But here's what history teaches us about surveillance systems. They're never built to catch the bad guys and then carefully limited to only affect criminals. They're built as general-purpose tools that get used for whatever the people in power decide they should be used for. The infrastructure that can freeze a terrorist's wallet can freeze a political dissident's wallet. The system that tracks drug dealers can track protesters. The database that monitors money laundering can monitor anything the government decides to call suspicious activity. Once the technical capability exists, the scope of its application expands based on political decisions, not technological limitations. And we're building this system voluntarily, with private companies doing the technical work during an administration that successfully convinced people they were fighting against digital surveillance money. That's the magic trick we're watching in real time. Now, let's talk about what happens when these stablecoin companies become actual banks. Because this is already in motion, and it changes everything about how our financial system operates. Circle has publicly stated their intention to secure a federal banking charter. When that happens, they transition from being a cryptocurrency company to being a regulated bank with all the privileges that come with that status. Direct access to Federal Reserve payment systems. Ability to offer FDIC-insured deposit accounts. Integration into the core infrastructure of American finance. But unlike traditional banks that evolved over decades with legacy systems and regulatory frameworks built for physical branches and paper checks, these new institutions are digital native from day one. Every account is a digital wallet. Every transaction happens on blockchain rails. Every customer interaction runs through surveillance infrastructure that was designed in 2025, not 1955. What you end up with is a banking system that has all the government control of traditional finance, plus all the programmable features of digital currency. It's the worst of both worlds from a freedom perspective, marketed as the best of both worlds from an innovation perspective. And here's the timeline that should concern everyone paying attention. We're not talking about some distant future scenario. The regulatory framework is already in place as of 2025. The companies are already operating under these rules. The treasury holdings are already happening. The freeze functions are already in the code. The only thing that hasn't happened yet is mass adoption. Most Americans still use traditional banks and cash for the majority of their transactions. Stablecoins are still primarily used by cryptocurrency traders and people making international transfers. But that's the current state, not the trajectory. What changes mass adoption from possible to inevitable? A crisis. Specifically, a banking crisis that makes people lose faith in traditional financial institutions and go looking for alternatives that feel safer. You want to know what's fascinating about the timing of all this infrastructure being built in 2025? We're heading into 2026 with commercial real estate markets showing serious stress, regional banks sitting on huge unrealized losses in their bond portfolios, and credit conditions tightening across the economy. If and when we see bank failures that trigger deposit flight, millions of Americans are going to panic and ask the exact question that this system is designed to answer. Where can I put my money that's safe, liquid, and accessible? And the answer that will be promoted everywhere is stablecoins. Digital dollars that are backed by treasuries, regulated by the federal government, insured just like bank deposits, but available instantly on your phone without requiring you to drive to a physical branch that might have a line around the block of people trying to withdraw their money. The next banking crisis won't look like 2008 with people lined up outside failed institutions. It'll look like millions of people moving money from traditional banks into stablecoin wallets because that's where the government and financial media tell them safe haven exists in the digital age. And once that migration happens, once your paycheck gets deposited in stablecoins and your bills get paid with stablecoins and your savings sit in stablecoin accounts earning interest, then the old system becomes obsolete not because anyone banned it, but because nobody uses it anymore. That's when the trap fully closes. Not through force, through convenience and crisis and careful system design that makes the surveillance infrastructure feel like the obvious choice during a moment of financial fear. This is what was actually accomplished in 2025 while everyone celebrated the death of CBDCs. The foundation was laid for a monetary system that has every feature people feared about government digital currency, built by private companies following government mandates, adopted voluntarily by citizens who think they're choosing financial innovation. The surveillance infrastructure is operational. The treasury financing mechanism is functioning. The freeze capabilities are coded and tested. The banking integration is in progress. All that's missing is the crisis that drives mass adoption and makes opting out impractical. And that crisis, based on everything happening in commercial real estate and regional banking, looks increasingly likely to arrive sometime in the next 12 to 18 months. Let's talk about what happens when that crisis actually hits, because the setup we've been discussing isn't theoretical. There's a very specific timeline playing out right now, and understanding it gives you a window to make decisions before that window closes. Commercial real estate in America is sitting on a ticking time bomb. Office buildings in major cities are running 30 to 40% vacant, because remote work permanently changed how companies use space. These properties were financed based on rent assumptions that no longer match reality. The loans are coming due, and the buildings aren't worth what the mortgages say they're worth. Regional banks hold enormous concentrations of these commercial real estate loans on their balance sheets. When these loans can't be refinanced because the properties have lost value, banks have to recognize losses. When enough banks recognize enough losses, some of them fail. And when banks start failing, depositors at other banks get nervous and start moving their money. We saw a preview of this in March 2023 with Silicon Valley Bank and First Republic. Deposits fled in hours once people lost confidence. Those banks collapsed not because they were insolvent in the traditional sense, but because they couldn't survive the speed of digital bank runs in an age when you can move money with a phone app. Now imagine that scenario playing out across dozens of regional banks in 2026 as commercial real estate stress intensifies. Millions of Americans watching news coverage of bank failures, looking at their own bank accounts, feeling that rising panic about whether their money is safe. What's the message they're going to hear from every financial authority, every government official, every fintech company with an advertising budget? Move your money to stablecoins. Digital dollars backed by U.S. treasuries, the safest asset in the world. FDIC-insured accounts through regulated companies. Instant access on your phone. No lines, no bank branches, no risk of being caught in the next failure. This is the adoption event that the entire infrastructure has been built to capitalize on. The crisis creates the fear, the stablecoins provide the solution, and millions of people migrate their wealth into the digital system, because it genuinely feels safer than traditional banks that are failing. And here's what makes this particularly effective from a control perspective. Nobody's forcing anyone to adopt stablecoins. People are choosing it because the alternative looks risky. The adoption is voluntary, which means there's no political backlash, no resistance, no sense that rights are being violated. You're just making a smart financial decision to protect your money during uncertain times. But once that adoption reaches critical mass, once enough of our economy runs on stablecoin rails, something remarkable happens to how the financial system can be controlled. Treasury Secretary Scott Bessent has been remarkably clear about the strategic vision here. He's stated publicly that stablecoins will reinforce the dollar's position as the world's reserve currency. And when you understand what that actually means in practice, you realize we're watching the construction of what some analysts are calling digital Bretton Woods. The original Bretton Woods system made the dollar the global reserve currency by tying it to gold and making other currencies tie to the dollar. It gave America enormous geopolitical power because global trade required dollars. That system ended in 1971 when Nixon closed the gold window, but the dollar remained dominant through momentum and lack of alternatives. Now, we're watching the digital version get built. Stablecoins export US dollar surveillance infrastructure to every country that uses them. A business in Thailand accepting USDC isn't just using a convenient payment method. They're plugging into a US-controlled financial system that operates under American regulations and can be monitored by American agencies. Every country where stablecoins become popular for remittances or trade or savings is a country where the United States maintains financial visibility and control. It's dollar dominance through technology rather than through military or economic coercion. And it's remarkably effective because people adopt it voluntarily for the practical benefits. But the real power of this system reveals itself not in the global geopolitical implications, but in what becomes possible domestically, once the majority of transactions flow through programmable digital infrastructure. Let's talk about what programmable money actually means when you follow the logic to its conclusion. Right now, the dollar in your bank account is just a number in a database. The bank can freeze your account, but the money itself doesn't have built-in restrictions beyond the balance amount. Stablecoins are different. They're not just database entries. They're smart contracts running code that can enforce any rules the issuer programs into the system. And once the regulatory framework requires certain features, those features become mandatory across all compliant stablecoins. Imagine we reach 2027, and 80% of American transactions flow through stablecoin payment rails. The infrastructure is ubiquitous, cash is rare, traditional banks are in decline. What becomes technically possible to implement through updates to the smart contract code? First, expiring money. Your stablecoin balance could come with a timestamp that requires you to spend it by a certain date or lose it. The government announces stimulus during a recession, but instead of hoping people spend it to boost the economy, they program the money to expire in 90 days. You either spend it or it disappears, no saving allowed. Second, negative interest rates. Right now, if the Federal Reserve wants to implement negative rates, they face practical limits because people can hold cash and avoid the penalty. But if your money exists only as digital tokens, the smart contract can reduce your balance by a percentage each month. Your savings automatically shrink to encourage spending and discourage saving. Third, transaction limits. The code can enforce maximum transaction sizes regardless of your balance. Maybe you can only spend $500 per day, or $5,000 per month. The limitation isn't about how much money you have. It's about how much money the system allows you to use at one time. Fourth, and this is where it gets really invasive, category restrictions. The smart contract can identify what you're trying to buy based on merchant codes or transaction details and simply refuse to process purchases in prohibited categories. Can't buy gold because the government wants you holding digital dollars. Can't buy firearms because that's politically convenient. Can't buy Bitcoin because that's competition for the stablecoin system. This isn't science fiction. This is what programmable money enables once it becomes the default form of currency and the regulatory framework requires compliance with government policy objectives. The technology to implement all of this exists right now. The only question is whether it gets deployed, and that depends entirely on how much of our economy migrates to stablecoin infrastructure. You know what system this starts to resemble? China's social credit system, where digital payment integration allows the government to restrict economic activity based on behavior and policy priorities. The difference is that China built their system through obvious government control, while we're building ours through private companies that follow government mandates. The outcome is the same, the branding is just more palatable. And here's the critical point that most people miss about systems like this. They don't get implemented all at once with dramatic announcements. They get rolled out incrementally with reasonable-sounding justifications for each new feature. First comes the surveillance infrastructure for anti-money laundering and counter-terrorism. Everyone agrees we should fight financial crime, so that's uncontroversial. Then comes the freeze function for sanctioned individuals. Again, seems reasonable to prevent enemies from using our financial system. Then during an economic crisis, temporary transaction limits to prevent bank runs and ensure stability. Makes sense during emergency conditions. Then expiring stimulus money to ensure it gets spent and boosts the economy. Seems like smart policy design. Then negative interest rates because we're fighting deflation and need to encourage spending. That's just monetary policy using new tools. Then category restrictions on things that are politically unpopular or deemed harmful. We already restrict some purchases. This is just making it more efficient. Each step seems reasonable in isolation. Each expansion of control has a policy justification. And by the time you step back and look at what's been built, you're living in a system where every dollar you own comes with permissions and restrictions programmed into its code. This is why the timing of everything happening in 2025 matters so much. This is why understanding that the CBDC ban was actually a substitution rather than a victory matters. Because we're in the setup phase right now, before the crisis, before mass adoption, before the programmable features get rolled out. You have a window of time where the old system still functions, where you can still withdraw cash from an ATM, where you can still buy physical gold from a dealer and store it outside the banking system, where you can still buy Bitcoin and move it to cold storage in a wallet only you control. That window is open right now, in late 2025, based on the trajectory of commercial real estate stress and regional bank fragility. That window likely starts closing in 2026, when the crisis triggers mass adoption of stablecoins as the safe haven alternative. And once enough people have migrated to the digital system, once stablecoins become the default way Americans hold and spend money, opting out stops being a practical choice. Just like how you theoretically could live without a bank account today, but it makes modern life extremely difficult. The historical parallel from 1933 is worth remembering here. When Roosevelt made gold ownership illegal with Executive Order 6102, it wasn't random tyranny. The government needed to devalue the dollar to fight deflation, but they couldn't do that effectively, while citizens could protect themselves by holding gold. So they made the protection illegal and forced everyone into the devaluation. The 2025 version doesn't require making anything illegal. The government just needs to make the alternative so inconvenient that voluntary adoption of the controlled system becomes the path of least resistance. And then once adoption is complete, the rules can change because opting out is no longer practical. This is the trap that's been set, not through malice necessarily, but through systemic design that serves government objectives while appearing to offer innovation and safety to citizens. The CBDC was the obvious threat that people would resist. The stablecoin is the private sector alternative that people adopt willingly. So, what do you actually do with this information? What are the practical steps someone can take during this window before it closes? First, understand that any wealth you hold in stablecoins is subject to the same surveillance and control risks as a government CBDC. The corporate logo doesn't change the functional reality. If you're using stablecoins for convenience or international transfers, fine, but don't confuse them with financial sovereignty. Second, maintain access to assets that cannot be frozen by code. Physical cash, while it still exists and still works for transactions. Physical gold stored outside the banking system, where no third party can prevent you from accessing it. Bitcoin and genuine self-custody, where you control the private keys and no company can freeze your wallet. These aren't get-rich-quick investments. These are hedges against a financial system that's being redesigned to give authorities unprecedented control over how you can use your own money. The point isn't to make a fortune. The point is to maintain optionality in a world where options are being systematically eliminated. Third, recognize that the crisis that triggers mass stablecoin adoption will be sold as the reason you need to adopt stablecoins for safety. The fear will feel real because the bank failures will be real. But the solution being offered is a trap disguised as safety. When regional banks start failing in 2026, you're going to see endless media coverage and government messaging about how stablecoins are the safe, modern, insured alternative. That's the moment when millions of Americans lock themselves into the controlled system thinking they're making the smart move. Understand what you're actually choosing if you follow that path. You're choosing convenience and apparent safety in exchange for financial surveillance and programmable restrictions. That might be the right choice for your situation, but make it with full awareness of what you're trading away. And fourth, this isn't about living in fear or paranoia. This is about understanding how systems work and what incentives drive their design. The people building this infrastructure aren't cartoon villains. They're policymakers and executives who genuinely believe they're creating a more efficient, more stable financial system. But efficient and stable from whose perspective matters. A system that's efficient for government monitoring and stable for government financing might not be efficient or stable for individual financial freedom. The optimization isn't for your benefit, it's for systemic control. We're watching the construction of the digital Bretton Woods, a monetary system where the dollar remains dominant globally, but the dollar itself becomes programmable surveillance infrastructure that every transaction flows through. It's being built by private companies following government mandates, adopted voluntarily by citizens seeking safety during a crisis, and presented as innovation rather than control. The CBDC ban was the misdirection that made this possible. Everyone focused on defeating the obvious threat, while the functional equivalent got built with better marketing and private sector branding. Trump didn't save us from digital tyranny. He changed who implements it and how it gets sold to the public. And the clock is ticking on the window of time where you can still make choices about whether to participate in this system or maintain alternatives outside of it. Commercial real estate is stressed. Regional banks are fragile. The crisis that triggers mass adoption is likely coming in 2026. After that, the trap closes. Not through force, but through convenience and fear and system design that makes opting out impractical. The voluntary adoption phase ends when enough people have switched over, that the old system stops functioning effectively. This is what happened on January 23rd, 2025. Not a victory for freedom, a substitution of one form of control for another version with better optics. The celebration on crypto Twitter was premature. The stablecoin trap was just getting started.